You are going to hear a number in the next few minutes that will be difficult to sit with comfortably. Not because it is complicated, because it is simple. Because once you understand what 30 years of $500 a month actually becomes, you will not be able to look at an unassigned $500 the same way again. That is not a warning. That is just what arithmetic does when you finally let it run all the way to the end. This starts the way most important financial decisions start. Not with a plan, not with a mentor, not with a moment of clarity that arrives like a scene from a movie. It starts with a Tuesday, an ordinary Tuesday where nothing is different, except that you finally stop telling yourself you will start when the timing is better. The timing is never better. You open a brokerage account. You set up an automatic transfer of $500. You buy a low-cost index fund that tracks the broad market. You set it to reinvest dividends automatically. And then you do the one thing the entire strategy will ask of you for the next 3 decades. You leave it alone. Month 1. $500 leaves your account and enters the market. The account now holds roughly $500. Nothing about your life feels different. Nothing about your financial situation feels meaningfully changed. This is the first test. Not a dramatic one. Just the quiet test of whether you can continue doing something that produces no visible feedback in the short term. Most people fail this test, not because they are undisciplined, but because the human brain is wired to respond to visible results. And in month 1 of investing $500, there are no visible results. There is only a number that is barely larger than what you put in. You continue anyway. By the end of year 1, the account holds around $6,200. You contributed $6,000. The market added roughly $200. That gap feels underwhelming. It is supposed to feel underwhelming. Year 1 is not where this story lives. Year 1 is just the price of admission. What actually happened in year 1 is not visible in the account balance. What happened is that you restructured your life around $500 less per month and discovered that the restructuring was survivable. The lifestyle adjusted. The discomfort faded. And the habit of treating $500 as already spoken for, already gone before you could redirect it somewhere else, that habit became the thing you do without thinking. That is worth more than the $200 the market added. The habit cannot be bought. It has to be built month by month until it is no longer a decision. Year 3. The account holds just under $20,000. Something is starting to feel different about the number. It no longer reads like savings. It reads like something that is operating without you. The money you invested in year 1 has been growing inside the money you invested in year 2, which has been growing inside the money you invested in year 3. Each dollar has been in the market for a different length of time and is compounding at its own rate. The result is a balance that is climbing faster than simple math would suggest if you only looked at your monthly contribution. Here is the number worth paying attention to at year 3. At $20,000, growing at a historically average rate of around 7% annually, the account generates roughly $1,400 in returns that year. You are still putting in $6,000. The market's contribution is less than a quarter of yours right now, but that ratio is not fixed. Every year, your contribution stays the same. Every year, the account gets larger. Every year, the return the account generates on its own gets bigger. You are not working harder. The money is, and it is just getting started. 5 years in, the account holds $41,000. You put in $30,000 of your own money. The market and compounding together added $11,000 that you did not earn, did not show up for, did not negotiate to receive. $11,000 generated entirely by the process of money left in a growing market earning a return. And that return, earning a return of its own. There was a year in there, year 4, where the market dropped sharply. Not a small dip, a real decline. The kind that shows up in headlines. The kind that makes people call their financial advisors in a state of controlled panic. Your account lost ground across several weeks. You watched the number fall. You did not sell. You did not pause the automatic transfer. You did the one thing that felt impossible while it was happening. Nothing. The account recovered. It always has, across every comparable stretch of market history. But you did not know that with certainty in the weeks when the number was falling. You stayed anyway. That decision, the decision to hold while the number moved against you, is the decision that separates people who build something from people who only participate when it feels comfortable. Comfort has never been a financial strategy. It never will be. 10 years. The account crosses $100,000, and that threshold matters in a way that is hard to fully explain. Below it, the account felt like a mechanism, something you were filling up. Above it, it starts to feel like a system, something with enough mass that it behaves differently than it did at year one. The returns in a strong year now approach $7,000. Your annual contribution is $6,000. For the first time, the account is generating more in a single year than you are putting into it. This is the crossover point. The moment when the capital already inside the account becomes a more significant driver of growth than the new money you are adding. You are still contributing. You will not stop. But the mathematical reality has shifted. The account is no longer waiting on you. It is running ahead of you. You also run a number you have never run before. You calculate what the account would hold if you had started 5 years later. Same contribution, same market return, same discipline in every other respect. The difference is approximately $58,000. $58,000 is the price of a 5-year delay. No one sends you an invoice for it. It does not appear on any statement. But it is real and it is permanent. And there is no version of year 30 in which you recover it. 15 years. $184,000. You put in $90,000 of your own money. The market contributed $94,000. That required nothing from you. The ratio is about to invert permanently. From this point forward, what the market adds in an average year will exceed what you contribute. You are not the primary driver of this account's growth anymore. Time and compounding are, and they will remain the primary drivers for the rest of the timeline, whether you increase your contribution or not, whether you watch the account closely or barely look at it. The machine is running. Your job at this point is simply not to turn it off. $363,000. That is not the account balance. That is the portion of the account balance that compounding built on top of what you put in. That is the number that most people never see, because they never start, or they start and stop, or they wait until the timing feels better, and discover that better timing never arrives on its own. That $363,000 is the actual cost of spending the $500 instead of investing it. Not $500 a month, $363,000 accumulated silently over 30 years while you were doing everything else. Here is what no chart shows you about this. The account at $543,000 does not feel the way you imagined it would feel at year one. It feels quieter than that. It feels less like an arrival and more like a fact, like something that has always been there in the background, running, adding, compounding forward regardless of what was happening in the foreground of your life. The market dropped multiple times across 30 years. The economy went through cycles that scared people who were watching. You watched too. The account went down and came back and went down and came back again. You never interrupted the transfer. Not because you were certain it would recover, because you understood that certainty was never the requirement. Consistency was. Somewhere tonight, there is a person in their mid-20s looking at $500 in their account that has not been assigned a purpose yet. It arrived this week. It is still unclaimed. In the next few days, Something will claim it. A bill, a plan, a moment of ordinary spending that will feel completely reasonable because it is reasonable. The 500 will leave, and there will be no record of what it could have become. They do not know yet that they are not holding a $500 decision. They are holding a $363,000 decision. And the Tuesday when they finally open the account and set the transfer and leave it alone, that Tuesday looks exactly like every other Tuesday. That is the part no one warns you about. The most important financial decision of your life will not feel important when you make it. It will feel small and quiet and slightly uncertain. It will feel like a Tuesday. The only question is, which Tuesday it will be.